All right, let's get right into it. As we roll into 2026, there are two completely opposite stories playing out in the United States. One is this huge display of global power, and the other? Well, it's a quiet, almost desperate signal of distress. So, on one hand, you have this incredibly swift military operation that puts American strength on full display for the whole world to see. But at the exact same time, totally behind the scenes and away from the headlines, the nation's financial core was flashing a massive warning sign, a real hint of a deep and pretty serious vulnerability. And this warning sign? It came in the form of a huge, sudden, and urgent demand for cash, right from the very heart of the American banking system. Get this, just between the last day of 2025 and the first working day of 2026, U.S. banks went to the Federal Reserve asking for nearly $100 billion. Now, let's be crystal clear. This was not some planned, routine injection of money. The source material makes it plain. This was an emergency cry for help from some major financial players. So you have to ask, where exactly did this $100 billion come from? And why does the specific source of this money matter so much? It all came from something called the Fed's emergency repo window. You can think of this as the financial system's emergency room. A bank only goes here when it's in real trouble, when every other lender out there has looked at them and said, nope, you're too risky for us. They literally have to hand over their best assets, like government bonds, just to get cash to survive the night. So yeah, using this window is a massive red flag. So that $100 billion figure, how big of a deal is it really? I mean, is this sort of thing normal? The short answer is a loud, clear no. The source material is incredibly direct on this. This level of emergency borrowing isn't just a little unusual. It's the kind of thing that has historically shown up right before some of the worst market turmoil we've ever seen. And just look at this chart. It lays it all out. The only other times that borrowing from this emergency window shot up to these levels were 1, at the absolute peak of the 2008 financial meltdown, and 2, in late 2019, literally right before the 2020 market crash. We are now officially in that same territory again. Okay, so what in the world is going on behind the scenes? What's putting so much pressure on these banks that they have to run to the lender of last resort? The analysis we're looking at points to a few potential culprits. First, you've got the commercial real estate market, which has just been hammered. Think about all those empty office buildings. Second, there's speculation that some big players got caught on the completely wrong side of a short squeeze in the silver market. And finally, some of these giant multi-billion-dollar trades related to AI might have just backfired badly. And here's where the story gets even more worrying. This desperate plea for cash didn't happen in a vacuum. In fact, the Federal Reserve was already in the game, actively trying to support the system. This is the crucial paradox. You see, back in December, the Fed had already pumped about $100 billion of permanent money into the system through quantitative easing. But even with all that permanent support, the banks still needed another $100 billion in temporary emergency funds. That suggests the underlying problem is way, way deeper than anyone thought. So with all of this happening under the surface, you have to wonder, how are the markets, the ultimate scoreboard, reacting to all these tremors? We're seeing a really mixed but very telling picture. Silver, for its part, has been incredibly resilient, holding strong at that key $70 level. Gold looks like it's building up steam for a potentially massive move. The S&P 500, on the other hand, is starting to look pretty weak, showing what could be a double top pattern. And Bitcoin? After a quick dip, it's recovered and is looking to push even higher. You can just feel the tension across every asset class. So this brings us right back to where we started. We have a massive, crisis-level injection of emergency money happening at the same time the Fed is already printing, and market indicators are flashing all sorts of signals, both good and bad. The analysis here draws a direct parallel from this situation right back to late 2019, which really leaves us with one powerful lingering question. Are we just watching history repeat itself?